Well, good morning and thank you for joining the Ellerston Global and Morphic Funds webinar. My name is Lisa Rose and I'm the Head of Intermediary Sales at Ellerston Capital. Today we're joined by Bill Pridham, who's the Portfolio Manager for Ellerston and Morphic's Global Equity Strategies. In today's presentation, Bill will provide an update on reporting season results to date, detail macro considerations influencing portfolio positioning, and provide an update on fund positioning and performance for April. I'm sure many of you will have questions for Bill, and we'll seek to answer as many of these as we can. If you'd like to ask a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the question section of your webinar panel, located on the right-hand side of your screen. I'll now hand over to Bill to start the presentation.
Perfect. Thanks, Lisa, and thanks everyone for joining me on another monthly webinar. It's always great to catch up and update you on the funds and thinking positioning as well. So with that, let's get into it. So as Lisa mentioned, we're really going to talk about the reporting season. We've had the March quarter results pretty much done now globally, and they've been quite strong. So we'll talk through that. We'll talk through some of the positioning considerations, outline how we're positioned currently, and we'll just touch on the performance at the end as well. So with the reporting season update, we'll just start off on that now. So the bulk of our companies have reported since we last talked. Literally in the last 2.5 weeks, we've had pretty much the whole portfolio report. So it's quite a busy and condensed season this time. Just on a broader level, when you think about the European, UK, and the US reports that we've seen to date, they've come in incredibly strong globally. And just an example, the S&P, the market was expecting around 24% EPS growth for Q1, came in at just under 50%. So think about that, just over a 20% beat rate in terms of what was expected and what was actually delivered. You know, what we've seen was really strength in cyclicals, so financials, discretionary, energy, materials really drove the beats. And what really was driving the overall market beat was the Q4 momentum continuing into Q1. So we're seeing the confidence building in companies, in consumers. We're seeing, the strength of that monetary and fiscal stimulus coming through as well. So, and that's got quite a long tail opportunity coming through longer term. But with that, we're seeing inflation really pop up. Pretty much every company talks about how much inflation they're seeing in terms of inputs. All the way from chemicals, lumber, steel, logistics, freight costs are going up. Very hard to get drivers out there. So a lot of companies are talking about freight increases, even in containers, especially containers. Global shipping container rates have skyrocketed, so that's really impacting the global cost there. And as we've been talking about for quite a while now, supply chain bottlenecks continue. That creates a bit of inefficiencies and doesn't seem to be changing anytime soon as demand continues to outpace the supply. So with that, many companies have been raising prices or about to raise prices. We've had a number of our companies talk about raising prices. Tempur Sealy, the bedding company, raised prices twice in the last few months. AZEK, which is a composite decking business in the US, they've raised prices 3 times in the last 6 months. And fortunately, they're able to offset the cost of goods sold inflation. So they have pricing power. And if you remember, we've talked about being in companies with that pricing power to offset this inflationary environment. And to date, they've been able to do that, which has been quite good. Interesting, we talked about that beat rate, over 20%. But on the average, the stocks have been down on the day of results. The initial price reactions have been quite muted. Could be a lot of that multiple compression we've been talking about. We talked about that on the last webinar. Could have been the whisper numbers, what was expected coming in. The other side of it could be, well, you beat by a substantial number this quarter, yet you didn't raise your full year guidance by as much. So what's going on there? I think the market forgets these are real businesses and real people running them. And there's still the COVID pandemic out there, so they need to have a bit of conservatism built in. So there could be a number of reasons why, but at the end of the day, the underlying business is performing quite well. So similar to the broader market, the majority of our companies actually beat nicely and a lot raised guidance for the full year as well. Similar to the market on the day of results, very muted share price performance, which actually gave us a good opportunity to add to our conviction. So we had updated earnings, updated guidance, and yet the share price wasn't reflecting that. So we're actually able to add to some of our positions. Some examples were Sensata, Tempur Sealy, Option Care Health, and Cellnex as well, just to name a few. So with the reporting season, I'm going to touch on some of the bigger companies in terms of the bigger positions that have reported. And with this, we're going to be talking around over half of the portfolio in terms of weighting. So we're going to touch on a lot of companies here. I'll run through them fairly quickly, just from a matter of timing perspective, but love to follow up afterwards if you like. But we're going to be covering quite a bit of ground here, so please bear with me. Firstly, we had PTC. As you remember, we did a deep dive on them a couple webinars ago. They reported very strong numbers. So their CAD business, computer-aided design, was up high single. PLM was up mid-teens. Very much driven by industrial activities, medical devices as well. Factory automation really coming through. Their growth part of their business, which includes Arena and Onshape, was up 64%. Very strong growth. And with that, they're seeing a lot of demand in industrial IoT, augmented reality, and the like. Well, so they reported Q2 revenues up over 28%. Earnings are up around 65%, which was well ahead of expectations. Revenues are up 10% above market. They upgraded the full year handily as well. And we see the business compounding earnings over the next several years by 20% plus. This was probably the worst performing stock on the day. It was down like 10%. And the commentary was, well, we didn't upgrade the full year as much as the first quarter. So, you know what we did get is a business that's actually exceeding expectations and providing good opportunity for us over the longer term. So you have these short-term moves which you have no control over, but longer term, you know the business is actually accelerating. Cellnex. So Cellnex, we've actually owned Cellnex for over 3 years now. We bought it in just early April a few years ago, and it was trading below 10 billion market cap at the time. You'll notice it's a lot higher than that today. They've had a lot of equity raises in terms of doing acquisitions, and the share price performance has been quite strong over the period as well. So if you remember, they're the largest owner of or independent owner of tower assets in Europe, and they've done a lot of acquisitions to date. They did a big equity raise not that long ago, and during that period, there's a lot of price weakness, and we took that opportunity to double our position through that timing, and we got our full allocation of rights as well. So they've announced $9 billion of acquisitions. They'll be closing over the next several quarters. And if you look at the Q1 revenues, up 40%, EBITDA up 45%. That's those acquisitions coming in, and they expect that to accelerate from here. And based on what they've got contracted to date, you should see EBITDA close to double over the next few years. They've got 110 billion of contracted revenues in place today, and roughly two-thirds is actually linked to CPI, so inflation protected. Now, the thing is, they've done the big equity raise, and they still have 9 billion of firepower to go. That will create quite substantial share price performance for us. We feel the core is well undervalued. Plus, you have the optionality of future deals coming through as well. So very excited to get that back up in terms of position sizing, and we see some good upside in that position longer term. Sensata, they're in mission critical sensors. When you think about tire pressure, emission pressure, braking, they're very much the leader in that space. And last year, they really got impacted by the auto market, which was down 20%. Heavy vehicle off-road, that was down substantially as well. So last year was a real big impact for them. Typically, they grow 4 to 6% above their end markets, so in auto especially. So you're seeing the auto market rebound now, and you're seeing heavy vehicle off-road rebound and industrial rebound as well. Interestingly, though, the last couple quarters, they've been outperforming by 9% plus, over and above the end market. So that's given them the opportunity to upgrade their full year guidance pretty substantially. The first quarter was a blowout quarter in terms of their performance, up 22% revenue-wise, and EBITDA up 45%. They're really benefiting from safety regulations. They're really benefiting from emission regulations and the shift to EVs as well. So they get 20% more content per car with an electric vehicle. You think of the battery management, you think of the drivetrain management as well. They are the leading player in that space. Very small part of the business today, but growing very strongly. With all this growth behind them, secular growth. It trades at 14.5 times PE. So you can see this business performing quite well, especially as the auto markets continue to improve. And we think about it, this year still being constrained by semiconductor chips, so the auto market's being held back. So we see these auto cycle potentially longer than it has been historically. And that will really benefit Sensata over the medium term. Moving on to Flex. So Flex is one of the larger contract manufacturers, both electronics and physical in terms of, you think of EV componentry as well. So they have a global footprint, which is really benefiting from they have Chinese exposure, but they also have the majority of their plants are outside of China. So they're really benefiting from the supply chain fragmentation going into their plants. So they're really levered to communications, so 5G kit, 5G equipment, industrial, automotive, one of the leading players in electric vehicle componentry, consumer end markets as well. So they had a very strong first quarter. So Q4 revenue was up, they had their full year results, sorry. So Q4 revenue is up 14% on last year. And now they're cycling some very easy comps that were impacted by COVID from the PCP. So we're going to see some very strong growth coming through. They've guided above market. The market was surprised they actually guided, so they have very good visibility. They guided well above market for the full year as well. And more importantly, one of our theses around this was their ownership of Nextracker, which is the largest solar tracking business globally. It has roughly around 30% market share. They're going to do an IPO. And that will crystallize value inside Flex. And we see that business at around $2.5 billion value. And when you back that out, the RemainCo trades at under 5 times EBITDA, coming out of trough earnings as well. Very strong balance sheet, very strong cash flow. So we see great upside potential in this business going forward. So Option Care Health, I was asked a couple webinars ago, what they are and that. But so if you remember, they're about home infusion. So if you're coming out of a hospital, elective surgery, and you need antibiotics or some sort of infusion, you can get that at home now. You don't have to stay in the hospital to get it. Secondly, you have the chronic side of things. So say Crohn's disease or muscular dystrophy or anything like that needs a consistent level of infusions. They provide that in an at-home setting. And so it's a real play on the home disrupting hospitals. So it's a real win-win in that situation where I can get treated at home. I don't have to travel to the hospital. I'm not worried about getting infections, and it's significantly cheaper from the payer point of view. So it really benefits both the payer and the patients as well. They're the largest independent player in the U.S., 95% coverage. So that was just a bit of a background just to refresh on what they are. They reported good first quarter numbers, revenue slightly ahead, EBITDA slightly ahead, upgraded their full year EBITDA guidance slightly as well. But the more interesting thing, they did a small M&A tuck-in this quarter, which I think is going to be a feature of the business for the next several quarters as they look for these opportunities. So you can see the business growing mid-teens for the foreseeable future as the hospital setting shifts to the at-home care. And with that, they get good leverage in terms of the operating model, which is great. More interestingly, when you look at the valuation of this business, it's fairly new. They bought a business called BioScript a little over a year ago, and now they got that full synergies coming through. And it's still quite unknown to the market of what they are and what they can actually do. So it trades at less than 13 times next year's EBITDA. And when I compare that to a company like Amedisys, who trades at 22 times plus, it's a substantial discount for a business that's arguably better in terms of the payer exposures and the pricing opportunity as well. So from that perspective, we see some great upside opportunity as this business gets discovered in the markets. Bureau Veritas. This is a real play on safety, security, traceability, you name it. So it's one of the largest testing, inspection, and certifications company globally. There's 3 big players. They're one of the largest in Europe in terms of exposure. They had their Q1 trading update during the month, and it really came in nice. So they had reported over 6% organic growth. Doesn't sound like a lot, but their market is still being impacted by the COVID pandemic, especially in Europe. The market was looking for 1%. So you look at that, 6% versus 1, margins are really starting to pick up, and they see the pace accelerating from here. Clearly, they have some very easy comparisons coming forward, which is great. But they're also really benefiting from the European Green Deal, which is spending on infrastructure. They'll really benefit from the President Biden's infrastructure plans on clean energy and just normal building growth as well. They're really focusing on electric vehicle charging stations. We're one of the leading players in that. That's going to be a strong driver for them going forward because all those charging stations need to be tested, inspected, certified because you don't want to get a jolt when you're charging up your car. Very strong business opportunity long term in terms of providing a B2B opportunity for businesses to make sure they're doing the right thing. And these guys check and balance that. Group SEB. I like talking about Group SEB because I've had pushback on it in terms of have they had pull forward of earnings, and I've always said I don't think so, and we're looking forward to the quarters coming up because when you think about it, they really didn't get a lot of pull forward coming through, but now they're starting to benefit from cycling. And if you remember, I was quite excited to look forward to their cycling of the week periods from last year. Well, they provided a Q1 trading update. The consumer business, which is small domestic appliances and cookware, it was up just under 40% organic in Q1. Clearly, it was cycling a weak COVID period, especially in China. So one of the largest cookware factories is in Wuhan, believe it or not. So that's now fully up and running. Q2 was even weaker for them last year, so they'll have another strong quarter. The biggest thing, though, they said was that they expect the full year revenues to be up 10% organically. Now, that's the strongest organic growth for the last several years. And I say several years, not just one or two, several years. So very strong revenue growth, and margins are picking up on the back of that. Now, the interesting thing, though, they have this coffee business, Professional Coffee, which they provide the industrial coffee machines to the likes of a Dunkin' Donuts or a Tim Hortons over there or Starbucks. And as you know, the hotel restaurants and that have been closed down. That professional business was roughly just under 20% of the business a couple of years ago in 2019. It's zero today. So we have the small domestic business doing quite well. We have the optionality of the professional coffee business coming in and starting to grow. Business trades at 15 times PE, 8 times EBITDA. And when I look at that compared to a Breville, which is an amazing business listed here in Australia, it trades like 33 times and 18 times EBITDA. So I see this business as great value, generates great cash flow, and the balance sheet's fantastic as well, with the optionality of the professional coffee business starting to ramp back up. So we see some good upside. Even though it's had a good run from the results, we still see some great upside going forward in the business. Tempur Sealy. I'm not going to talk too much on Tempur Sealy because I talked about it a lot in the past, but what I wanted to point out was they had guided to 15 to 20% revenue growth for this year. That's on the back of an 18% growth last year. They upgraded that to over 20% growth for the year. They're seeing some great traction in their Tempur-Pedic rollout. They revamped their whole line last year, so they're seeing that come through. They're benefiting from there was an anti-dumping legislation come in recently, so they're really benefiting from that from a bed point of view. Europe's still difficult, but starting to pick up. We'll see that really come through in 22 going forward. So you can see the business is performing quite well. That's even with a lot of supply chain bottlenecks. They reckon they left over $100 million of sales on the table because they just couldn't get the supply in place. On the call, they talked about actually getting that bit more normalized next quarter, so they're catching up, which is great. So now you'll see the numbers really start to reflect a proper demand-supply balance in that respect. So as I mentioned, they upgraded their revenue guidance. They upgraded the EBITDA numbers for the year. They've raised prices to offset inflation. Interestingly, this last quarter was impacted by that Texas weather impact in terms of chemicals. They said, that's quite transitory for them, and they're seeing the chemical prices normalize now, so they didn't think they needed to get that one. But they've offset all the previous cost input inflations, which is great. So when you look at the business, trades at 13.5 times PE, 9 times EBITDA, similar type of free cash flow yield, high single digit. They're buying back 6% of the company. It just continues to perform well. And with the mattress industry long-term growing mid-single, we see them growing high single-digit. We see some long-term growth opportunities, and we're not paying a lot for that growth today. XPO Logistics. So we talked initially about a lot of companies complaining about freight costs and the inflation they're seeing in freight. Well, nicely, we're participating on the other side of this as well. So we have XPO Logistics, which is one of the largest less than truckload businesses in the U.S. They're a large player in Europe as well. The U.S. market is quite consolidated in terms of less than truckload. So there's really three big players. XPO is number 3 in this space. So they're really benefiting from the tightness in freight. They're getting good price rises through. Their growth this first quarter was fantastic. EBITDA was almost 15% ahead of market expectations. Again, raised full year guidance quite substantially for the business. And one thing this management team is generally quite conservative in that sense. So if they raise their full year, you can see that they're getting good visibility in the business, and that's coming from the pricing they're seeing in their markets. This year, in the second half, they'll be spinning off their contract logistics business. The contract logistics operations is one of the second largest globally, and it really benefits from the e-commerce shift. When you think about all these companies that are doing a lot more e-com, reverse logistics, we're one of the largest player in that. Last mile, one of the largest players in that as well. So what we see post-spin are two pure play businesses, very strong businesses, and I believe we'll get a re-rating on the back of that as well. So that'll happen more in the second half. And even with that, it trades at less than 10 times EBITDA. Comps are 12, 14 times. So we can see some good opportunity there as that spin comes through later in the second half. And we know fundamentally the core business is trading exceptionally well. Now, I want to just touch on the regional banks. We had trimmed them a little bit because they've had a strong run. They're very much levered to rising interest rates, improving commercial loan growth. A lot of the commercial banks are more commercial and industrial in terms of their exposures. So the larger banks have a lot more residential loans. Commercial banks, the regional banks typically have more commercial and industrial loans. So they're really levered to the industrial rebound that we're seeing from that perspective. Look, the Q1 results were just off the charts for these guys compared to what was expected. Like America was like 80% ahead, in terms of EPS. But the majority of that was driven by loan loss provisions that they had taken historically being released now. In the Q1 last year, as a group, they reserved about $850 million to protect themselves from the risk of loans becoming impaired. Well, we had the balance sheets already coming in quite strongly from a corporate and consumer point of view. So that risk wasn't as much. They're being very prudent at the time. And with the fiscal and monetary stimulus, the market or the economy's bounced back much faster than expected. So, you know what? I think we'll see the majority of those reserves written back over the next couple quarters. And what that's going to do is create a lot of book value growth. It's going to create a lot of capital return opportunities as well. So you have that coming through. But then on the other side of it, you have a lot of optionality. They're awash with liquidity, these banks. The amount of deposits they have compared to loans is incredible. So roughly, 70% loan to deposit ratios. As an example, Comerica Bank has $14 billion on deposit at 12 basis points. They're earning 12 basis points on $14 billion. The loan growth has been anemic over there. If we see the loan growth start to pick up with the economy picking up, they'll be able to deploy that at proper 200 to 300 basis point returns. And you can see 20 to 25% EPS growth as that comes through. So from that perspective, they've had a strong run since we bought them in September. We still see some great upside opportunity with them as well. When you look at their valuations, they trade as a group around 13 times, well below market, which is in the 20s. And they're trading at levels that are roughly at historical lows relative. So they're still well under-owned. So we can see some good upside potential in them as well. So that's a bit of a rundown in terms of the reporting season with some of our bigger positions. As I mentioned, we've just talked through over half the book with the positions we've talked about here. So now I want to touch on some of the positioning considerations. I'm not going to spend a lot of time on it because there's not a big change from the last webinar, which we were quite in depth in terms of the macro side of things. But, when you look at this chart on the left-hand side, that's the pure definition of a V in my mind. So this rebound has been much stronger and much faster than past cycles in terms of GDP growth. And when you think about it, it's quite intuitive. So coming into this downturn caused by the pandemic, the consumer balance sheet was pretty good. Corporate balance sheets were pretty good. So we didn't have to go through that repair period where we did through the GFC. Much different setup coming in. And the governments and central banks of the world were much faster and aggressive in terms of monetary and fiscal policy. So we've had that come through. When you have that backdrop, the consumers and corporates, they can come back into the market, come back into the economy with a bit more confidence because effectively they have a lot of liquidity behind them to do this. And, real personal income's never been higher at the end of the day. And we talked about that in the last quarter. But I just found this chart on the left side there just exemplifies how fast and sharp this rebound has been. But with that, and we talked about supply chain, inflation has really started to emerge as a risk. It's really starting to come through in terms of the numbers. If you cast your mind back a week, we had CPI printing at 4.2% in the U.S. That's the strongest print we've seen for a very, very long time. And the market was a bit spooked on the back of that because that was their first real hint of inflation starting to come through. We've been talking about inflation being higher than expected and growth being higher than expected for a while now. It's starting to come through in terms of the numbers. The big thing now is that, or the interesting thing now, the discussion is around, is this a transitory inflation, which means will we, in a year's time, look back on this and say, yeah, it was a spike, but we've grown out of that? Or is it more sustained going forward? Hard to call just yet. The interesting signpost out there on the night of that 4.2% print, the 10-year in the U.S. barely moved. So it kind of tells you that the market's still thinking this is transitory in terms of inflation. I think it's harder to call, but I don't think we're at a point where we can really say that inflation is going to peak and then drop pretty dramatically, especially when we're hearing all the supply chain issues still flowing through and demand being quite strong. We really haven't seen the fiscal policy really start to feed through yet. There's a time lag there, so that's really got to come through as well. We have the stimulus checks really starting to come out now. The child tax credit starts in the middle of July, so that's a big driver going forward as well. So we have a number of things to watch in this type of environment. Typically, and we're seeing it. Your frothy valuation stocks underperform. The techie end of the market typically underperforms, and what does perform is more your cyclicals, industrials, financials, and we're seeing this come through. And we've been positioned for this for a while, which has worked out well. One thing I wanted to highlight on the right-hand side there of the chart, the bar chart, the last two expansion periods have averaged roughly 10 years. This one's going to be a lot quicker. We're seeing things come back a lot quicker. So it could be 4 or 5 years in terms of this cycle, which means we have to be active around this. You can't take a passive approach. If you look at the overall index level where it is today, it's still at closer to all-time highs, right? But underneath that, there's been a lot of pain. When you look at some of those frothy valuation stocks, a lot of the tech stocks, they've been derated materially through this period. Now, as a barometer, you think of Cathie Wood's ARK fund, which is very much the high-tech type of companies. Since the peak in February, it's down over 35%. So we've seen companies in this area down 30, 50%. So you can see the market's still near an all-time high, but underneath the hood, there's been a massive shift. And that's my point. You need to be active and be ahead of these changes. And because the markets are moving much quicker now, you got to be very nimble around this. And that's what we're doing. And that's what we're making sure we have a finger on the pulse to make sure we're ahead of the curve. So with that, we'll talk it through the positioning. The left-hand side of the barbell's getting crowded. So we've been more on that value angle for a while now versus growth. We have a couple businesses in that high growth area, the LiveRamp and LivePerson. They had some LiveRamp will report their numbers in the next week or two. LivePerson had some amazing numbers as well. But if you look at it, that barbell was very much the opposite of that 12, 18 months ago. We're in consumer discretionary, we're in industrials, we're in financials. So we're very much in that cyclical bent in terms of the positioning there, because we see some strong undercurrents in terms of drivers there. But when you think about the growth part of the barbell there, they're not frothy businesses. So Cellnex they own infrastructure. They own long tail, high return assets in Europe. We talked about PTC, we talked about Sensata, and Ritsu and Keysight. They're about 5G testing, and Ritsu trades at like 9 times EBITDA, right? So these aren't high valuation stories where you're hoping that growth will offset the multiple that they're trading on. There's some really strong business in there that still perform quite well in this type of environment, and a lot of them are underpinned by industrial activity as well. So from that perspective, it's still that barbell approach. We still have some exposures to those higher growth industries, but we have a lot of value defensive names in there as well, which, you know what, the trajectory is still performing quite well for them, and pretty confident, especially since they've all reported now, and the majority upgraded the numbers. We feel pretty good about them for the rest of the year. Even though they've had a strong performance with that recent reporting season, we've upgraded our valuations, so we can still see some really good upside in those names. And we touch on performance now. So financial year to date, the fund's up just a little over 31% compared to the market, which is just under 26%. So it's a nice outperformance on that front. What I wanted to point out, though, because the fund is unhedged, the strong Aussie dollar has really impacted the absolute number. So when you look at fund year to date, the Aussie dollar is up around 12.9%, which means that the stocks inside there are up in the mid 40s, being offset by the strong Aussie dollar. You know, I've talked about the Aussie dollar in the past being a strong offset. In a risk-on environment, it's gonna be stronger. But what I have seen in the past is that in risk-off periods, that the Aussie dollar creates a great hedge for the portfolio. So, you know, from an unhedged point of view, it's difficult to watch it as it appreciates as the fund's appreciating, because you're giving those returns from an absolute perspective to the Aussie dollar, but it does provide a great hedge in a risk-off environment. So since inception, we're running at a little over 17%, which is great. I just wanted to touch on the upside downside capture. Since inception, just over 100%. So we're capturing over 100% of the upside nights and moves in the market, while capturing less than 80% of the down moves. So if we can continue that, and knock on wood, we can continue that trend, we should create some outsized returns for us all as investors in the fund. I want to touch on Morphic Global Opportunities Fund, which is the trust. Again, if you remember, I'm running these as mirrors of each other. So when I talk about the Ellerston Global Fund, I'm talking about the Morphic Fund in terms of positioning. They're all the same stocks. And if you remember, I took over the fund in October. So during that period, I've shifted them into the Ellerston framework. And since that time, the performance has been good. And what you'll see going forward, there's a difference here clearly in terms of returns, but what you'll see going forward is that the returns will be very close to each other from here on in. And also, I just wanted to touch on the listed Morphic Fund, the Morphic Ethical Equities Fund. If you remember, we always talk about the dividend profit reserve in place. It's just over 28 cents at the end of April. Just this morning, we released the first half report and accounts, and I wanted to call out the dividend in there. The board has declared a 2.5 cent dividend for the interim, which is up 150%, 150% on the interim of last year. That's a function of good performance numbers coming through, good profits coming through, and basically it represents an annualized yield of just around 4.5% now, which is great because when you think of that running dividend of 5 cents, great opportunity for us to release some of those profit reserves we have in place. And with that, you look at the profit reserve in place, it's roughly just under 5.5 years of coverage there. So we've got good coverage in place, and I'm pleased that the board increased the dividend because we've been talking about the opportunity there from a dividend profit reserve in place. So very happy with that. And with that, Lisa, I think we can go to some Q&A.
Thanks, Bill. We've got some great questions that have come through for you already. The first one is, Bill, the stock stories are not only financially interesting, but inspiring about how the world is changing for the better. How do you avoid falling in love with the long-term vision and missing the downside as the hype is so exciting?
Oh, that's a really good question. The hype that's a great question in terms of timing, because when you look at what has happened over the last 3 months, renewable energy hype with President Biden coming in was off the charts. We've seen a lot of those companies come down 30, 40, 50% through that period. Now, how do we avoid that hype? Is we really focus on the fundamentals. We've been looking at hydrogen for a while now. We're looking at a company called Ballard Power, which was over $30 not long ago. Now it's just over $14. We couldn't get our head around that valuation vis-a-vis the business of what it was. So how we avoid that initially is very much focused on our fundamental valuation approach and making sure the numbers match the story. We got to make sure that when they're talking about their order book, that it's actually growing very strongly and not flatlining, which that company was. So we're very focused on making sure the fundamentals match the story. So that's how initially we look to avoid those minefields. A lot of the companies you own today, yeah, they do very good. When you think of the Bureau Veritas, as you think of the AZEX of the world, SIG Comblock, we are very focused on the risk reward around them. And with that, we have trimmed. So SIG, we had trimmed AZEC. Bureau Veritas still has some great upside in it, so we still maintain a strong exposure there. So we very much focused on our risk reward. We'll trim them where we see fit. And I've said in the past, if we see them get extremely overvalued, we will exit them. To date, though, they haven't been extremely overvalued, still providing some good returns for us. But it's a matter of trimming and adding where we see appropriate from a fundamental point of view. But when you look at some of these renewables and some of those frothy names over the last few months, they've been absolutely obliterated. And the big thing is to maintain your fundamental view and make sure those numbers stack up with the stories. That's a brief example of how we do it.
Thanks, Bill. The next question that's come through for you, Bill, has there been any new positions added to the fund since our last update?
Yeah, so there's been one actually, and it was a spin-off. So it was, if you remember, we're very much about price discovery and trying to be ahead of the market where when you have a corporate event, the market can take time to recognize an asset. So there's an asset in the UK called Travis Perkins. So they have a business called Wix, which they spun off and created a pure play with the Travis Perkins as RemainCo. Now, Travis Perkins is the largest distributor of building products in the UK. Now, with that, the business is going to be levered to the UK stimulus, which is coming through, especially the housing formation, which is very much underbuilt. So they have a benefit from that. They benefit from inflation because as a distributor, they pass through those prices, and it's like moving boxes. You get an extra dollar per box, and a lot of that flows through to the bottom line. So you have the inflation beneficiary, you have the UK stimulus beneficiary coming through as well. The business trades at around 7.5 times EBITDA for this year coming up. It's a net cash balance sheet next year, 3.5 billion market cap for the largest UK distributor. I think that's really good value. And one of the other angles as well, when I looked at Home Depot taking back Home Depot Supply, which is basically what Travis Perkins is, they paid 13 times in December this past year. So you can see a business that's going to be growing quite nicely, inflation beneficiary with great valuation support and a very strong balance sheet. So that's one of those new ones that we've added. It's not one of those high flyers type businesses where we're hoping that earnings will hoping the multiple grows into the earnings. It's on 7.5 times today, and with all these nice tailwinds behind it as well. So that's the only new one, and we're just building our position in that as we learn it.
Thanks, Bill. Next question, could you please provide me with an update on your current cash holding? Has this increased or decreased since last month?
So cash has been quite consistent. If you look at it on aggregate, it's decreased slightly. What we've done, I mentioned earlier about trimming. We've trimmed some of those companies that have really appreciated a lot. And post-reporting season, we've been able to flip that, not flip it, but move it into more of the bigger, higher conviction plays that we've got. As I mentioned, we've gone through that reporting season, and a lot of the companies upgraded the numbers, and the share prices didn't react. So it gave us an opportunity to really concentrate the portfolio a bit more. If you notice, we got a lot of 5% positions now where we wouldn't have had that in the past. So from a net point of view, cash levels haven't changed a lot. Call real cash at around 91%. But with that as well, we have some hedging in place. So we have a long instrument which adds to exposure, but it's actually a short market play. So net, if you look at invested exposure, it's running around 87%. So a little bit lower than it was last month, but not too much dissimilar.
Thanks, Bill. That's it for questions at the moment. I might give participants the opportunity to send through any others outstanding that they have. And while they do that, Bill, I might pass back to you for a final comment.
Yeah, sure. Thanks, Lisa. So I think, we look over the last few months, it's been quite important to understand the macro. We've always said we were mindful of the macro, but we're focused on the micro. And the last webinar was very much macro focused, which kind of sets you up for where the micro is going. We listen to our companies. And this past reporting season was very strong. It was actually one of the more frustrating ones or less satisfying ones. We had so many companies beating guidance or beating guidance substantially and raising for the full year, but I've never been through a period where the share price reaction has been as muted given the beats. But that gives you the opportunity as a fundamental investor to really take advantage of the near-term market myopia and buying companies that are trading at 12, 13 times multiples. We're not in very high frothy multiple businesses, but those multiples that we're buying, they're growing at 15, 20%. So we can see some really good upside in those businesses, and they're leaders, global leaders or domestic leaders in their space with strong secular drivers behind them. We're not playing in those real froth businesses which have been carted out. As you know, we're very focused on capital preservation, and with that begets a lot of work to make sure we're paying the right price for our businesses. And as it stands today, we're very confident in terms of what's driving our businesses today. We've just had recent updates and pretty confident in terms of where they're placed. And even though they've had a good run over the last financial year to date, we see some great upside from here. So I guess that's one of the main takeaway I wanted to highlight.
Well, thanks, Bill. We haven't had any additional questions that have come through, so we might leave the session there for today. So to all participants, I trust you found today's sessions useful. A recording will be sent through to everyone shortly, and we've also secured the next date for our Global Equity webinar, which will take place on Tuesday, the 22nd of June at 10 a.m. You can register to attend via the News and Insights section on our website, ellerstoncapital.com. If there's anything further needed post-session, please don't hesitate to contact a member of the Ellerston distribution team directly, as we're more than happy to help with any matters as required. Thank you again for attending, and I trust you all have a good rest of your day.
Great. Thanks so much. Take care.